I've been, for the last 3 years, I've been in real estate. I've worked many times with Liz going, including she helped finance the home I'm sitting in right now. So
Same.
Liz is, for those of you who don't know Liz, she's extremely competent and in finance, and also a free stater herself, and always there whenever we've ever asked for her to help us at Port Fest or any other location. Liz is always willing to come out or come online to talk to our clients and offer them the best of services in the finance area. So Liz, I'll let you start with telling us a little bit about the changes that we're going to see.
Yeah, so a lot of the changes that that we're going to talk about, they've actually already been in effect for a couple months now. Most mortgage companies, most competent mortgage companies have already worked a lot of these sorts of things that are in the headlines right now, already into their pricing. Because a lot of these LLPAs, which are loan level price adjustments, a lot of these, they go into effect as of March 1st in terms of the delivery date to Fannie Mae or Freddie Mac, the conduit, Fannie Mae or Freddie Mac. So that means that the loan has to be closed, sealed, and delivered. And that's when these things go into effect, is on that May 1st date. So chances are, if you've closed in the past month, or two even, it usually takes about a month to 2 months to actually finish post-closing a file and actually get it shipped and delivered to Fannie Mae and Freddie Mac. So for that reason, lenders have to price in these sorts of things early and ahead of time to ensure that the loan is delivered with the correct pricing in time for these effects to. Does that make sense?
Yes.
Okay. So I think, Constance, I think you're muted for a second.
Yeah, you were muted for just a second. I don't know if I accidentally muted you. Sorry.
It's okay.
You did this really cool Instagram video that I wanted to share to kind of get us started as well, because you cover a lot of that in this little video. Jack, do you have screen sharing on for this?
Yeah, I'll turn it on. Just a minute, I gotta find the advanced.
If anybody doesn't follow Liz's social media or on all the places that she is, they really should, because they're very informative, they're very entertaining, and they're pretty quick. So you can learn a lot with a short little blurb. And that's why I specifically wanted Liz to do this for us, because and as she's already given us a summary, we don't expect this conversation to take necessarily a full 30 minutes. I am now have a visitor. She says hello. All right, let me see if I can screen share it now. Okay. So this is probably not right at the beginning because I just found it. And I need to unmute you there. There we go.
This has been going on for a while. This is not great. Okay. We've been working on all sorts of requirements that were put out by the FHFA since like February as we first got the notice. So recently closed. If you're pre-qualified following,
We need more volume, Constance.
you're currently under contract, locked in an interest rate. Most likely, these things are already factored into your interest rate, so no worries there. Now there is one that's coming on May 1st. Okay, so there was a whole slew of them that were updated in February, but on May 1st, there's one more that they originally wanted to do, but then they decided to delay it. And May 1st, I guess, is the day that they decided to delay it to. Anyway, what they want to do is they want to put an additional hit on your pricing for your interest rate if you have over 40% debt to income ratio. So how I feel about that obviously doesn't matter because I don't write policy, or how I feel about the rest of these. But either way, it's not big news, people. These media headlines and stuff like that, they must have just caught wind of this like yesterday, because everybody's up in arms, and us in the industry, we were up in arms in this back in February. And, we're now over it, and now we're calloused and scarred from it. So anyway, it's not a big deal. I don't know why it is now, but whatever. Just let it roll off your back. It's not a big deal. We handled it already. It's already happening. Have a good week. Hey y'all, another episode of Liz's Friday Thoughts, my opinions on what's going on in social media.
Okay. That was really loud on my end. So I'll stop sharing. But I thought that was great, Liz, because I think like that, I mean, if we really ask how these rates are calculated and such, my guess is that this is just the latest in a long line of government interfering with rates, correct? And
Yeah, I mean,
so,
Fannie Mae and Freddie Mac, they're like a quasi government agency, which means they're kind of under the wing of the government, but they also are free to kind of do their own thing, like these sorts of things. So, I don't really, feel one type of way or another type of way. I'm sure you can imagine about the current administration. But for the sake of remaining neutral, I would like to say that for the first time ever in my life, I'm going to defend the guy. And I'm going to say that, like, people attributing this to Biden is completely unfair because he has no control over interest rates and policy. He can have an influence over what type of lending ideas they want these quasi-government agencies to uphold, which is, to make low-income borrowers or moderate-income borrowers or the average American who maybe doesn't have the most perfect credit, make home ownership possible for them. But that's always been their mission, And so,
yeah.
I think that headlines specifically attributing all of this to Biden specifically, I think that that's a far reach and a very polarizing, sensational headline compared to the actual truth that Biden really has nothing to do with the FHFA. That they're kind of their own wing and they get to do and write whatever policies that they want. And to further that point, this is not something new. We're always seeing rate adjustments. We're always seeing loan level price adjustments come out. And I find it very curious how when last year, if any of you remember, the FHFAs, aka Fannie and Freddie, decided that they no longer really wanted to partake in second homes and investment properties. And so I don't know if anybody remembers when these loan level price adjustments were established, but these were established in 2021. And these have cost people who want to buy second homes and investment properties. The interest rates are incredibly high. They made it incredibly expensive. They pretty much took the attitude that we don't really want to do second homes and investment properties. We'll still do them, but it's going to cost an arm and a leg to do so, to essentially try to squash that. But there was no media coverage of that back then. Nobody cared. Nobody said anything. And that was way worse than any of these LLPAs that we've seen rolled out so far this year.
And wasn't that in response to the Airbnbs too? Like a lot of people were buying second homes so they could put them on Airbnb and not disclose that they were going to use them as a short-term rental.
Yeah, it could be. That's one of several reasons. It could be a reason that maybe Fannie Mae and Freddie Mac want to get back into exclusively dealing with, primary residences. That's where they really want to stay. They don't want to be dealing with the inflated, the risk that inherently comes with a second home that you're not at all the time. So if the pipes burst during the winter and the bank's collateral is ruined, so be it, or the inherent risk of an investment property, that in the event that, something terrible happens, the housing market crashes, people are going to be more apt to prioritize the mortgage over their own roof rather than taking care of the mortgage of their investment property. Of course, that's just a theory, in my opinion. That's, not representative of FHFA and whatever other compliance stuff I'm supposed to be saying.
We'll take this as Liz going.
I don't always keep track of what the lending policies are with and the amount of points that are being charged on the loans. I think where the issue comes out in this instance is the direct tie to your credit ratings, your FICO score. So the fact that if you have a lower score, you're also given a discount on points as compared to the points that were charged just 3 months ago. If you had a higher score, like a 750 or so, you paid 0.25%. Now it's 1%. So I think it was just a case of where the appearance is a redistribution of wealth. I understand the concept of, wanting to encourage first home buyers with lower credit ratings, but the fact that it was tied directly to the credit scores, it wasn't such a wise decision.
I mean, there's always been penalties or rewards for people having higher or lower credit. This is nothing that's new. So in terms of that, I think that a lot of the hype around all of this is just, first of all, where did this all start, right? This information rolled out back in January, the end of January, early February is when they announced that these changes were happening. And it wasn't until last Monday when an opinion piece was written by somebody at the Washington Post with a sensational headline that this even became something that people talked about. And I think a lot of it is because we have people that don't have NMLS numbers. You can look up mine. It's 1818156 because I'm a licensed loan officer. I'm licensed to talk about this stuff and I'm required to know about this. We've got a lot of people who don't know the first thing about mortgages. I mean, as you guys know, you watch the TV as real estate agents and you're listening to people talking about how the housing market's going to crash and have been talking about how the housing market is going to crash. And these people aren't real estate agents. They're not licensed to talk about real estate. They don't know the first thing about comparable sales or anything like that, or what a CMA is, So we've got these people that are talking and reading these charts that we have internally, or that other mortgage, Mortgage News Daily and different types of websites that we subscribe to for our intel, that they just don't understand what these charts mean. So to them, they see that there are worsened LLPAs for people with higher credit and improved LLPAs, aka less punishment for people with lower credit. And they're not necessarily realizing that this doesn't mean that somebody with a 780 FICO score is getting a worse rate than somebody who has a 680. That's not the case at all. You're always going to have a better interest rate, or I'm not supposed to use the word better. You're always going to have a more competitive interest rate by having a higher credit score compared to somebody who doesn't. And a lot of this talking about subsidizing and this and that, and it's not that somebody with high credit is getting a more expensive interest rate, so that way that money can be redistributed to somebody who doesn't have a good credit score. The person with a bad credit score is still getting a bad rate, I'm not supposed to use that word, a higher rate. So there is, there's people that are like, oh, well, I should just tank my credit score in order to get a better interest rate. And it's like, wow, well, that's the worst thing that you can do. Because these people are still being hit. As a matter of fact, I would like to say that thankfully, since FHA kind of changed their mortgage insurance rate, most lenders at this point in time, if somebody's walking in the door with like a 670 or a 660 FICO score or below, we're not really looking at conventional financing for them. And this only pertains to conventional financing, because conventional financing and the interest rates and the private mortgage insurance rates for them is so much more expensive than FHA. I'm really, in terms of a lot of this notion that there's this redistribution of wealth and that, putting 20% down with a great credit score is no longer, you are still being rewarded for that. And if we want to go into why 20% down, sure, everybody thinks that that's the best thing, but it's actually not. It's actually one of the worst interest rates that you can get. And we can explain why that is, compared to putting 25% or 15% down. We could talk about that.
I would love to talk about that. And I would like to say,
I'm
I'm scrolling through these news articles. I mentioned before we started recording that the recent articles are all, like, every third one has the word Biden in it, but I scrolled back and it says January 3rd, NerdWallet had new.
That's my birthday.
Happy birthday in the past.
Thanks.
FHFA credit score rules could broaden homeowner access. So it was a news article January 3rd on NerdWallet.
Yeah.
And it did not mention Republicans or Biden or anything in that one.
Right, because this is not necessarily like, this isn't like Joe Biden's administration said that. I mean, obviously, you know, they kind of steer the course of where they kind of want home ownership to go, but there's always been, when Trump was in office, you know, there was huge initiatives, you know, towards helping minorities, you know, get into programs and things. And these sorts of changes, they take months, arguably years to roll out. You know, it took us years for FHA to write a handbook that was cohesive. You know, so these things, they don't happen fast. It's government, right?
FHA has been around since at least the 80s, right?
Right, but for them to actually come out with the cohesive 4000.1 that we have now, that's so nicely written and clear and everything like that, it took years for them to come out with.
Okay.
And any sort of resolutions, like their change to student loan debt qualifications, though that I think that was like 3 or 4 years in the making that it took for them to change that policy. It doesn't happen overnight.
And I do want to tell everybody that Liz told us about this way back.
Yeah.
So
Yeah,
we had
we've
already,
known about
we
it.
as agents had already heard about it. So that's another reason I wanted you to come on. But we got a yes, please in the chat for you explaining why the 20% down is one of the worst.
Yeah. So the reason why people say 20%, you want to, you know, people say that you got to put 20% down on a house. The reason for that is when you have a 20% equity position in a property, you're not required to have mortgage insurance. Okay. That's where the 20% myth, you know, and I don't want to call it like a standard. But that's where the 20% idea comes from, is because you don't have to pay mortgage insurance. Okay. But what is mortgage insurance? Mortgage insurance insures us, the lender, that in the event of default, that a lender is going to recoup some of that money, you know, that they lended out in the event of default. Now, when you put 20% down, you are right out of needing mortgage insurance. If you put 19.99% down, you're going to have mortgage insurance. Okay. If you put 15% down, you're going to have mortgage insurance. But if you put 20% down, you are right outside that line of needing mortgage insurance, which means if there are any market fluctuations, potentially, you know, that there's no wiggle room for your equity position, if that makes sense. Are you following?
Yeah.
So by putting 20% down, it's actually pretty risky to a lender. And an interest rate is nothing but a reflection of risk of a particular loan file. Okay. So if we remember that, you know, if somebody has poor credit, why is my rate so high? Well, you have poor credit. You know, you're just more risky. You know, your credit profile tells you that there's inherently more risk. Or if you have a great credit score, your interest rate is going to be a little bit lower because your credit report indicates, you know, the data shows that you are going to pay this debt. Now, when you put 20% down, this is risky because you're right outside needing mortgage insurance. So if the market turns and home prices go down, you know, the mortgage and then you default, the mortgage lender is not protected. Whereas if you put 15% down, the mortgage lender feels very, very good because there is that mortgage insurance that's on the loan. And what will happen is that interest rate, although you're only going to pay mortgage insurance for a couple years, you know, if you don't appraise out of it sooner, you're going to still have that benefit of that interest rate. That's, you know, that less risky interest rate for the remaining 30 years of that mortgage. So the sweet spot is really either putting, you know, 15% down or 25%.
So
Down. That 20% is kind of the red zone.
Liz, you can ask for a reappraisal. Is that right, of your loan, of your value house on your loan? How many times can you do that? So if you think the value of your home has gone up, but you only had, you know, 17, if you're at 17% equity based on your purchase price, you could ask for a reappraisal and get below that to get rid of your PMI. Isn't that correct?
You can request it from your mortgage servicer and ask them if they have the opportunity to reappraise the house in order to appraise out of mortgage insurance.
Yeah.
Whether they tell you to go pound sand, you know, based off of their internal calculations is a whole nother thing. But there you can always, it's absolutely your right as a property owner to ask that sort of a question.
Right.
So we have another chat question. Would you make the case for putting more than 20% down?
Yeah, certainly. Like I said, that spot, you know, between 20% and 25, that's like, ugh, you know, I when somebody's like, I want to put 20% down, I'm like, really? Well, maybe we should do 25. instead. The person says, why? It's because now we've got that 5% area kind of built in now. So if there's any sort of market fluctuations, we know that, there, it allows for it. And that you have a greater equity position takes a little bit less stress off the lender. So therefore the interest rates start to improve at 25%, 30% is really good too. So I would say, 15 or less, or, 25 to 30 if you can.
And this is another one of those things that we always encourage, not going outside our lane. So as realtors, like, this is where we'd say, talk to your financial advisors, talk to your accountant, because if you're locking in a 30-year mortgage at 6 or 7%, but you could make 10% with that, at some point you've got to figure out, like, does paying the mortgage insurance make sense for a little bit if you could make more money, or if you need the funds elsewhere. I will say, as a realtor though, I think the sooner you buy, the better you will be in the long run. Especially if you're starting in investing, buying multifamilies. Okay, so the next question is, regardless of credit score, can you more easily shop interest rates with a higher down payment? Did she freeze up? Did I freeze up?
No, you didn't freeze up. Oops.
Oh, we lost Liz. There she is.
She's back.
Sorry. I've been having problems with Xfinity all week. I don't understand what is going on, but.
So I think the question is, even if your credit isn't as high as you'd like, is it easier to get a better rate with a higher down payment?
Certainly. And every situation is going to be different because there are multiple things that go into an interest rate. Like, I call it interest rate science because it kind of is a science. So there's things about, occupancy. That's one loan level price adjustment. We want to talk about LLPAs that are existing. We've got ones for credit score, obviously. The type of property that you're buying, is it a single family, a 2-family, or a multi? Is it a condo? Is it a detached or attached condo? How much are you putting down? Is it going to be your primary investment, second home? So these are all different factors that can go into your interest rate. So certainly, trying to offset maybe poor credit by putting more money down to kind of offset that risk. Certainly it could. It's obviously not going to be as high as if somebody with a 780 FICO score is putting 30% down, but it could certainly help. But we would have to definitely take a full application and run it through the system.
And that's why you can get an idea of which direction rates are heading by looking at a website online, but you really need to be working with yourself or a lender and getting your particular file looked at. And when do you recommend people contacting a lender? I know as agents, obviously, we want everyone to be in touch with a lender before they start looking at houses, but I've talked to a lot of people recently, and I'm like, you can start now, even if you don't think you're going to buy in for a couple of years, just to get an idea. So what is your thoughts on that?
I mean, I would say even just having an introductory conversation to at least find out what is a mortgage and how do I get one is always good to have as soon as you have that first thought. At the end of the day, most lenders, we want to have these sorts of conversations because it helps our clients long-term to prepare. Because a lot of the times you hear, oh, there's zero down programs, there's low credit programs, there's first-time home buyer, there's all these sorts of programs. And, for us to figure out which kind of avenue is going to be good, we want to intercept you as early as possible. So that way we can coach you on maybe where you need to go. It's like, oh my God, well, do I look at credit or do I work on saving, or do I work on paying down debt? What do I do? So even if you're not ready, you can be a year or even 2 years out. I've talked to people that are 2 years out, getting a gauge for where their credit is, where their savings are, and where their capacity is another thing, because sometimes some people just have a lot of debt. And don't necessarily have a lot of income. So they don't have room in that budget for a mortgage. And, it's a lot better to know that up front and be able to work towards that for the next couple, months or years, rather than to just be like, I'm going to buy a house. 2023 is my year. Let's do it. And then you get told that you can afford a $5 house.
Yeah. And I mean, it impacts so many decisions. I was recently talking to somebody who had just got his first job, out of college, and he was admiring my new truck, which I bought after I had my mortgages.
Thank you.
And you're welcome. And he was like, oh, I just got a job. I'm like looking at cars, and I'm like, please just take my card, do me a favor, talk to a mortgage person before you make any big purchases. If you think you're going to buy in the next couple years, like I'm almost 50 and this is my first new car ever. So like, right out of college, it might not be the time to be buying the same car that I just bought. But I also just thought while you were talking that with a change like this, so if somebody does have not as high a credit score as they'd like because of something that happened a few years ago, if a change like this comes through and if you have their file, you can then reach out to them and let them know that something's happening that might help them buy as well. So establishing that relationship with a lender early on is a really good thing.
Yeah, certainly.
I'm sure in the, and I know this happened because you sent us emails reminding us, but as we went from 3% to 7%, Liz had to keep in touch with all the agents that she works at, letting us know what a pre-approval was going like. So if somebody was at 500, then they were at 400, and such. So I'm definitely singing the praises of working with Liz early.
So Liz, some of the, just quickly, and then some other tips. The lowdown on the lowdown payments, how is that going? Are they being offered again?
Yeah, so there's still, VA and USDA programs, which are 0% down. There's still out there these programs that are for low to moderate income borrowers, where they cap it at 80% of the area median income. It's tough in New Hampshire, I'm not going to lie, because home prices versus what 80% AMI is, it's kind of hard to make the numbers work. Especially in this market when it's super competitive, but it is still out there. And I'd like to note that these LLPAs don't apply to those programs like Home Possible and Home Ready. So if somebody is in those types of programs, these loan level price adjustments that have come out, they don't need to worry about them because they waive LLPAs on those programs because they're specially designed to help foster home ownership within those lower income communities. They also typically get a little better of an interest rate because it is, one of these mission driven programs. They also usually get cheaper mortgage insurance as well for those two programs. So, those are really great options. So I'm glad that you mentioned that. I did have that in my notes as something to bring up. So thanks for guiding us to that, Jack.
You're welcome. Okay, do we, if anybody want to put on their microphone and ask a question that didn't type a question in? Any other tips anybody wants to find out about? No.
I think we should leave everybody hanging, and they'll have to join again in the future to find out more information. Let's keep it
Yes,
at that half an hour.
That's
And we'll have more sensational headlines to talk about soon.
That's
I'm
right.
sure.
Yeah. Now, I did want to mention with these LLPAs, something that was really exciting that did come out is they did add another tier for credit scores. So they did add one. So up until, recently 760, if you got a 760 score or higher, we don't care. You're in the top tier. They did add another tier for 780 plus. So now, now the people that have those 700 and 800 FICO scores, they're going to be rewarded even more. There is another opportunity for another pricing bracket that has been established. So as always, this isn't a cause for alarm, no big deal. I don't know if the news is just slow or if there's some really serious stuff happening that they don't want us to pay attention to. So instead they're pushing this kind of insane, makes me as a lender want to rip my hair out rhetoric, day in and day out. But everything's okay. It's already worked into your pricing. No worries.
Great.
It is what it is.
All right, more to come. Thanks so much for joining us.
Thank you,
tonight.
Liz.
Of course.
I
Thanks for
think it
having
was
me.
Pretty informational, and we got some tips out of it as well about when you should apply and how much your down payment should be.
Yeah.
That 80%, that 20% down payment may not be the best. Thank you so much.
You're welcome. Thank you.
Thanks,
Bye, everyone.
everybody.
Good night, everyone.